Good morning or good afternoon, everyone, and welcome to another Fintech Nexus webinar. My name is Peter Renton, Chairman and co-founder of Fintech Nexus. And today we are talking about lending, specifically innovations for smarter and quicker lending decisions. Because every lender today, we are in a hyper-competitive environment for consumer loans, and anything you can do to make a quicker decision, which is what really consumers expect today, but most importantly, a smarter decision, which is going to impact your bottom line. And we have two experts here who are going to guide us through this process, providing lots of practical advice along the way. So with that, we'll start some introductions. Ryan, why don't you go first?
Yeah, thanks, Peter. Hi, Garrett, and greetings to everybody that's shown the interest and taken the time to join us. My name is Ryan Coleman. I'm with Equifax Workforce Solutions. I have the pleasure of running a direct sales team that offers our data and our solutions out to the non-mortgage lender community. I also have the pleasure of managing our technology partner relationships. Our data often is delivered and is consumed by the lending community through technologies like Amount. So another one of my responsibilities to manage technology partnerships with companies like Garrett. And nice to be here today.
Okay, thanks, Ryan. Garrett?
Yeah, good morning, good afternoon, everyone. My name is Garrett Laird. I work with Amount. We are a digital origination and decisioning platform. We have offerings for personal loans, credit cards, lines of credit, all the different flavors that come with that in the consumer and small business space. I focus on our decisioning platform. So that everything from deciding what third-party data providers like Equifax that we work with, as well as the functionality that our decisioning engine provides our customers. I also have a focus in the fraud and AI space as well. Prior to Amount, I worked at a direct lender fintech company. So I've been in this space as both a direct lender and on the technology side for a little over 7 years now, and looking forward to the conversation.
Okay, before we get deep into the conversation, we've got just a handful of slides that we're going to go through. So I'm going to share my screen and hand it off to Ryan here, who can just give us a little bit of background for the conversation.
Excellent. Thanks, Peter. We just wanted to start with an acknowledgement on the economic environment for consumers and our customers. Not really breaking any news here with what's seen on the slide, just appreciating the consumer environment, the reality of student loan balances and repayments coming back into being a real part of the monthly cash flow for consumers, and the effect that has on their budgets and their spending habits and abilities. Inflation has been tough over the last couple of years, easing but still high. We all experience how much things cost these days, whether it's real estate, whether it's your groceries, everyday life. Inflation is definitely persistent and something that is challenging consumer cash flow. And that all sort of has a spillover effect to the bottom two highlights pointed out on the slide. A little bit of a creeping up in delinquencies and credit balances. Card balances being high is something that everyone's seen in the headlines, and obviously debt to income ratios remaining high. So just kind of a persistently challenging environment for consumers. But those consumers still need access to financial services. They expect quick decisions. They expect that process to be easy. And companies like Amount and Equifax, the Work Number, we're here to help lenders address that pressure, but do so with speed, delivering a good customer experience, and also just making confident decisions, taking account into things like risk. Risk has to be controlled. Lenders don't want to necessarily loosen credit policy to be able to grow their loan programs. And so how do we take a tough environment for borrowers, but yet grow our businesses responsibly on the lender side? All these things are just challenges that everybody's dealing with today. So what we have here is just an example of two identical credit scores with fundamentally significantly different financial profiles underneath that same credit score. We have Thomas at a 726, we have Susie at a 726, and using traditional credit file data, those applicants may look similar on the surface, but when you dig a layer or two deeper across lots of different components, you can see that very often, whether you're talking about a prime borrower, a near prime borrower, subprime, et cetera, all throughout different credit bands, you'll see very often fundamentally different financial profiles underneath that identical credit score. And so how do lenders quickly dig a layer deeper beneath that credit score and understand the financial profile of these applicants and make smart decisions that also work for the applicant? Next slide, if you don't mind. And that leads into us just talking about financial inclusion. Lenders want to reach new audiences, whether it's a younger demographic, new to country, lots of different types of applicants that oftentimes are very worthy of a loan. How do lenders score those thin file or no file applicants, such as a young professional or a new to country type of customer? We see here in the middle column in the green bar down below that over 60 million credit files are believed to sort of qualify as that thin file label. Of those 61 million thin file borrowers, we believe that 50 million of them, or the large majority of them, are scorable. And companies like Equifax, but also other bureaus, other alternative data companies offer lots of different recommendations on how lenders can have visibility and measurable data on those thin file applicants so that they can either make an automated decision with some of that alternative data or go into a manual review and look underneath that credit score or that thin file and potentially make a high confidence loan offering to someone that they maybe would have hesitated to make a loan offer on without that additional layer of alt data. This is just an example of some of the alternative data sets that Equifax offers underneath the traditional credit file. There are things like digital identity, how to confirm that who your applicant says they are is in fact who they truly are. We have asset verification. We have some commercial data sets for small businesses. There's a whole specialty finance demographic, the payday loan space, the BNPL loan space. We have lots of data sets that track consumer behavior in the specialty world, the payday world, the BNPL world. Equifax also offers some really unique data sets on telecom and utility payment activity so that sort of behavior can also give the lender another way to score a thin file or a no file applicant. And then of course, income and employment, that's close to my heart. I represent the work number here with Workforce Solutions. The work number, which we'll get into on a slide here in a minute, the work number offers, we're up to 170 million active employment records that are verified straight from a employer provider or a payroll aggregator partner. And we're approaching 700 million historical employment records. So verifying income and employment position, whether it's a current job, or multiple current jobs, or even a prior employment position. That's what the work number brings to the lender community. And with so many job changes, there are so many job changes. People transitioning jobs is higher than ever. People working multiple jobs is something that's very common, and the work number can help a lender access that verified information and make fast decisions. Just a little bit of a visual here on the work number database of verified income and employment. Our data comes from the left-hand side of the screen. We have relationships with over 3 million employers who contribute payroll information directly to the work number. That payroll information refreshes and cycles with all of their payroll updates, whether they're onboarding new hires, people are retiring, people are enjoying job changes or promotions. That data comes from a network of over 3 million employers and growing. We also have data provider relationships with big payroll aggregators and payroll platforms. That's reflected in the bottom left. We call those our payroll alliances. We have information, the records that I talked about on the prior screen. Information comes from those sources on the left, and under FCRA regulations and use case allowances, we are able to offer access to the database to lending verifiers over on the right-hand side of the page. We work directly. We offer direct relationships with our lender community in the bottom right. Verifiers and lenders oftentimes will do manual verification over our web tool. We offer a batch capability, which is just a big bulk file. A large file will come from the lender community into the work number. We'll verify perhaps a large portfolio for portfolio review, or a card line increase type of use case via batch. APIs directly into our lenders are common for loan underwriting, where an application comes in, a lender wants to make a quick decision, and we can fulfill that moment with a real-time API call and request. And we also have relationships with technology companies like Amount, which with one integration to a partner like Amount, we build one integration with a company like Amount, and Amount is then able to offer work number functionality inside of their decisioning tool to all of their lenders that are on their platform and prefer the Amount workflow. We love working with technology partners like Amount. It makes the speed to production happen much quicker for those lenders. We deliver data natively through that Amount decision engine, or that Amount tool that the lenders are already happy with and familiar with. And when we activate that integration for that lender, the work number data just shows up in that tool that they're familiar with, and they're able to run their program more efficiently because of that partnership.
Okay. Well, let's thank you for that, Ryan. That was really interesting. Maybe Garrett, I'll just turn to you real quick, and maybe you could just describe in a little bit more detail of how you are actually working with Equifax and how the lenders are accessing the work number data.
Yeah, absolutely. Right. So again, just a quick high-level overview of what we do at Amount, right? So we have a full end-to-end offering for loan origination solutions, again, in the consumer and small business side. And we obviously partner with Equifax, both for their credit report and all of that data, as well as the work number is a critical part of our income verification flow, right? So we ingest applications, right? Our decision engine will decide, right, does a particular applicant need to go through income verification or not? If so, we have a waterfall of different options for that consumer to verify their income. And generally at the top of that waterfall comes the work number. The reason for that is, first of all, I know we'll probably get into this in a lot more detail, but the second you start requiring that an applicant verify their income, we see massively different conversion rates. Right? If, for example, if someone applying for a personal loan, all we have to do is verify their identity, they've got great credit, they're not asking for a particularly large loan, we can just fly them through. Really high conversion rates, do a great job. As soon as we start asking for income verification, say we have to ask for a document, that conversion cuts in half, if not worse. The reason we love the work number is the customer doesn't need to know that anything is happening, right? It's an API call, it happens in real time. The applicant doesn't lift a finger, and we get really reliable data that can say, yes, this person works where they said they work. They've been there for however many months, years, et cetera. They make X dollars, right? And we're able to generate that decision in real time. I think the other really powerful thing about a tool like the work number is there's a big adverse selection factor that comes into play, right? So when we'll get into, just general friction in the customer journey, but generally your most motivated applicant is probably the applicant that you least want to give a loan to, right? They're the customer that's going to be willing to jump through as many hoops as you put in front of them, either because they have malintent or because they have less options than a really qualified customer. And so as soon as you ask a really good, pristine applicant to, for example, upload a document, right? They're gonna say, you know what, I've got 5 other offers that all look pretty similar. I'm gonna go to one of those lenders and get a loan. Whereas if we're able to call the work number, they don't know, it's real time, right? There's no customer friction, so that's great. The other thing we see is, right, document uploads are a little bit more problematic from a fraud perspective, right? You can go to a dozen websites right now and download a fake pay stub that looks really good, or you can download a tax doc or a bank statement, right? All that stuff is free, not quite free, but publicly available and easy to do. So if you go to a tool that is API driven, like the work number, tapping in directly to payroll providers, employers, right, the risk of fraud goes down pretty dramatically. And so when we review just credit performance for customers that we've verified via a tool like the work number versus, right, something that requires extra effort, right, we see a pretty stark contrast. So it's great in both conversions and then the performance we see down the road.
So just to clarify, when a borrower is going through a process, and this may differ, I guess, between lenders, but is it just a checkbox? Like, do you give us permission to go check your income data, or how do they actually present this option to the borrower?
Yeah, I should be careful. I don't want to put my foot in my mouth because I am not a lawyer. I believe we capture all of those consents, right, as kind of the same process for consenting to pull credit, like make decisions. We tell them we're going to pull some other third-party data to verify your identity, maybe some things around verifying your employment and income. So it's generally for the flows we've established, we've already collected that permission to go to a provider like the work number. So it's not even an extra checkbox step for us. Ryan, I don't know if you want to confirm that that's generally the flow you see as well. But that's
yeah, good question, Peter. So the work number is absolutely an FCRA regulated data set. The permissible purpose sits with the lender. At the moment that an application happens, in the language and the disclosure of the application language that's presented by the lender, they need to make sure to remain FCRA compliant, that they're being very specific about disclosing to the applicant and getting their consent that they have the right to verify income and employment through a third party. They don't have to name the work number. Most often they don't. They're free to use other verification services. But yeah, that disclosure happens at application. The lender has that permissible purpose and the obligation to satisfy FCRA. And we do go back and audit, periodically the fact that consent has been captured and that our lenders and verifiers are compliant.
Gotcha. Okay. So maybe let's take a step back and let's talk about managing risk. And you touched on it, Garrett, about friction, but you want to maybe Ryan, I'll go to you to start this one. What do you think are the key factors in managing risk in a frictionless customer journey? And obviously, you can't have it completely frictionless, but relatively so.
Right. Yeah. So again, there's some amount of user experience in every lender's application process, and those are all even putting the Work Number aside, whatever that application process looks like, what that looks like on a laptop versus a mobile phone, it's really important that all the lenders continue to refine that friction. Friction can happen in lots of different ways. In regards to specifically verifying income and employment, like Garrett said, many times lenders today still rely on asking simply for self-stated, customer types in, the name of their employer, where they work, what they make, how long they've been there. That takes, we've all been in that position as a consumer. That takes, whether it's 30 seconds, 45 seconds, a couple of minutes, there's a bit of friction there. There's room to either intentionally or unintentionally overstate or understate something, to mistype something, so there's room for error there, whether it's intentional or not. Then you get into, like Garrett had mentioned, the request to upload either a tax statement or a set of tax documents, potentially upload pay stubs. There's time and friction and room for some fraudulent activity at that moment in time. So there's all sorts of friction and room for either intentional or unintentional errors or fraud. Counter to that, when you think about verifying information via the Work Number or even another verified provider of income and employment data, again, as long as those acknowledgments and disclosures and consents are in place, the lender is able to make a call to one or multiple different income and employment verification providers. And based on the coverage and the response and what that return looks like, the lender has an instant set of information that they can make an automated loan offer decision on. The risk, the risk managers, the folks in charge of credit risk, they love the tool. They love this process and this tool, not just because of the efficiency and the automation that this sort of setup enables, but it also, and none of these, as much as I would like the Work Number to have 100% coverage, we don't cover every employed individual across every industry and type of employment, whether it's self-employed or the gig economy. But using a service like the Work Number or multiple services like the Work Number allows a lender to maybe automate half of their application volume or 60% of their application volume, and then do a manual review and point their human capital at a much smaller subset of their production program, as opposed to what they maybe would do without a tool like ours.
So, Garrett, I'm curious. I mean, you've been with Amount for a few years now, and and the Work Number obviously has been around for a while, but it feels like, from my perspective, we're seeing more lenders now moving into this type of data like that. I'm just curious to see if there's what you've noticed, because I mean, to me, the whole go and upload your pay stub, I mean, that just feels like a 2010s thing. That's not a 2020s thing. And so what are you seeing actually on the ground?
Yeah, I mean, I think you're absolutely right. And maybe just to echo some of the things Ryan just stated, right? One of the things we really strive for is customer engagement, right? If someone's on your application, answering your questions, giving consents, accepting an offer, we don't want to have to say, okay, now hold tight while we render your decision, or right, go get this other thing and come back to us, right? As soon as you do that, we see just a massive drop off in conversion. So we try and keep everything real-time decisions, right? Customers engaged, like we want to get that product issued in their hands as quickly as possible, right? So that's why, right, these tools that are real-time decisions don't require a human interaction, right? Human interaction meaning, right, like someone reviewing a document, right, reviewing an application, right? So that's one of our real goals, and we try to automate just about every step of our application process. There's always the fallback, right? There are just edge cases where you need a human to get involved, but right, that while you have the engaged customer, it's critical that you kind of are able to do absolutely everything to book that loan, that credit card, that open that deposit account, what have you. To your question around like uploading pay stubs being 2010s, I completely agree, right? I think there are there's been kind of a flood in the space of other providers that try to take away the physical upload aspect of that, right? There are options to connect directly to a payroll provider, directly to a bank account, right? There's the 1033 rule coming out to make that data like available across financial institutions, right? All of those are still requiring some level of effort from the customer, right? It's not download and upload a pay stub that like a human has to review, or maybe some OCR tech these days is reviewing. So there's definitely been a lot of development in the last couple of years in making all of that driven via just API real-time access. Again, I think the reason we keep a tool like the Work Number at the top of our waterfall is it's totally behind the scenes, right? The customers have already given their consent. It's no additional steps. It's not give us your username and password. So it's definitely that gap around, right? Because as Ryan mentioned, no one has 100% coverage, right? There's always that's why we have a waterfall, right? We have those other options, but there's definitely been a movement in the last few years to make as much of that digital and in real time as possible.
Like the friction involved in logging into your payroll provider or logging into your bank account. I mean, there are some people that are probably pretty used to it, but there's a lot of people that are going, oh my God, I don't know my login. I don't remember my, so, I presume you're also seeing drop off in that type of situation, correct?
Absolutely. There's two huge kind of cliffs that we see. The first is as soon as you ask for a doc, they just never upload it, right? And then the other problem is kind of gets back to that engagement piece where, okay, I've uploaded my document. Now I need to wait for you to process that document and get back to me, right? And that's where, right, maybe while they're waiting for an answer, they're going to one of your competitors to see if they can get a loan today because they need the money, or they don't know what your answer is going to be. So I think it's exactly right. It's those two cliffs, right? It's the hassle of logging into your bank, your payroll provider, downloading, uploading a document, and then it's the waiting for you to make a decision that customers just don't want to deal with these days.
Sure. So for everyone watching, if you have a question for our panelists here, we will be doing those in a little bit. So hit the Q&A button and get those in. So I want to go back and talk about thin file borrowers. Ryan, I was struck in your presentation there that, there's, like, I think you said it was 60 million, but 50 million of them are scorable. And so like that means, you can, they're still going to be thin files. I said you might have between 1 and 4 trade lines, whatever. But how, like, is the Work Number really, is that where it shines? I mean, what is the sort of way that lenders can get a more complete picture of that 50 million or so people?
Yeah, so great question. Something that's going to remain consistent with lenders for any applicant is, are they employed, and do their earnings, satisfy the loan offer that's being requested or considered to be offered. And so that employment position and that income profile of that thin file, or even, someone with a full file or a prime borrower, it's still that income and employment position that is arguably the most meaningful criteria that a bank or a lender would want to verify, however they do it, whether they use the Work Number or they manually verify it or take a different approach. That's still arguably the most critical item that they're trying to confirm. And again, most of these, many of these young people have jobs, have their first job, new to country. Many of them are employed in a meaningful way. And the Work Number will provide that instant. If we have that contributor, we don't have 100% coverage, but many times there's 170 million active records on the database. And so if we can provide a verified employment an income profile of that thin file or that no file applicant, we give the lender a very reliable, instant sense of reliability around that person's income and employment position. Now, if there's other if there's other criteria that come into play, certainly there are. We talked about our telecom and our utility payment information. We talked about the information that we provide around specialty lending, payday lending behavior, BNPL behavior. We have other data sets that can surface other meaningful criteria to a lender. The Work Number brings the income and employment picture to bear for a thin file applicant. And again, not all, but many. And so there's lots of different ways to define scorable. Income and employment is a big one. And yeah, the Work Number definitely shines in that regard.
Right. So what is actually returned? And maybe I'm not sure, Garrett, if you can answer this, but what is the actual data that is returned? And is it dependent? I mean, is it configurable for the lender? So, like, are you getting back, okay, this is the last 12 months of income. This person's been at this job for 3 years. I mean, what is the actual data that is returned to the lender and how are they using it?
Yeah. So I certainly could answer that question, but I doubt I could answer it as well as Ryan.
Right.
So I might let you handle that, and then I'm happy to talk about how our clients use that data.
Yeah, great question. So we have a variety of different income and employment solutions. The information that a mortgage underwriting team would want to look at varies dramatically from the information that someone issuing a smaller balance retail credit card would need to make a decision. So the needs of those loan programs vary. Quite frankly, the budgets of those programs and the margins of those programs are wildly different.
Right.
So because of the depth of information that each of those types of lending programs require, as well as the budgets and the margins of those programs lend to be able to apply to data, we offer different data sets for mortgage underwriting, for auto lending, direct, indirect, specialty lending, student lending, refinance, credit cards. And that's just speaking about the differences that we offer to loan origination. When we move into account management, when a lender would want to stay on top of how their open loan portfolio is behaving and how to segment their portfolio based off of changes in either credit score, income, employment, we price that use case differently than we would an origination type of use case. So we have those conversations with the lenders and make sure that we understand the needs of that program. Another example is current employment versus historical employment. Some underwriters may only care about a currently active employment position, where a different lending program with a different credit policy may really value previous employment. So because of all the nuances of lender to lender and program to program, we can really offer a specific set of information to those user groups. And then we just make sure that we're partnered with Amount to offer the suite of solutions that any of those lenders may want to use at any given time. So we kind of partner and integrate with Amount for the kitchen sink, I guess you could say. And then based on any of the end clients that raise their hand and want to utilize the Work Number, we make sure that we set them up with exactly what they like and what they need.
Okay, so obviously highly configurable. So Garrett, how are lenders typically using this data? How do they bring it into like their models?
Yeah, so generally what we've seen, the use cases, the primary use cases, right? The Work Number will return current and historical employment, right? Current and historical pay rate, right? Hours worked. They give you a current year estimated annual income. And we try to be flexible, right? Like we'll parse that data and give our clients optionality as to exactly how they want to use that information. We also come with our own opinions, and generally the crux of it is, right? Does your current employment align with what you claimed, right? Or do you work where you said you work? do you make as much money as you say you make, or at least within a reasonable margin? And then what's the stability of that income, right? Were you unemployed for all of last year and just started a new job last week? Or have you been in the same place for 4 years? Or were you employed, just changed jobs, right? Like those stability of income things our clients tend to care about. To Ryan's point, it'll vary pretty dramatically if it's a mortgage application versus a $5,000 personal loan, right? Your stability probably needs to be a little different for depending on the product you're offering. But generally the quick answer is, right, we want to make sure you're making as much as you make, you're employed where you said you're employed, and there's some stability to that income.
Right. So maybe we can just dig in. I know we've got a lot of questions coming in, but maybe one more question before we go to those. And talking about the different use cases, like where would you say, Ryan, that alternative data is essential when it comes to the different use cases for lenders?
Yeah. I guess it also depends on what the different definitions are of alternative data. We use these words like fintechs and alternative data, something that, there's 5,000 credit unions in the country, for example, something that a very innovative credit union may define alternative data, maybe, a different one would not. So I think alternative data is becoming more the norm. Again, if the Work Number is sort of categorized as alternative data, we're very well penetrated in the mortgage space. So something as traditional as mortgage and the Work Number, that's been around for, decades. And so, I would say it's instrumental everywhere. Where it's becoming more and more required as table stakes is definitely in the fintech space. Any fintech, any digital or mobile to consumer financial services or banking or loan programs that are happening digitally, primarily online through a laptop or through a mobile device. Those folks, especially including, a Gen Z demographic, if you're looking to adopt that type of borrower and deliver the right type of customer experience, those people are not responding with any sort of extended amount of time doing screen after screen of self-stated, steps and hoops or uploading documents. The attention span there is very low. So, your fintechs, your BNPL programs, anything digital centric and especially mobile or point of sale, you've really got to adopt new sets of data to be able to deliver those results.
Okay.
If I can jump in on that one too, Peter, unless you want to move on. I'm just glad, Ryan, you mentioned credit unions, and I just wanted to call out, right, one thing we're really excited about is a relationship we now have with, recently branded as Valera, formerly PSCU. They merged with Co-op, represent thousands of credit unions. And one of the things we constantly hear from credit unions is, how do we say yes to more people, right? Their mission is, how do they best serve their members? And I think, especially depending on what their target demographic might be. So for example, if they're a university-based credit union, they might be dealing with lots of young people, 18, 19-year-olds who have thin files, limited credit history, or right, graduate students who are just moved here from another country and right, have perfectly stable incomes, have great credit history in another country, but we just don't see that. And so alternative data becomes really important in those populations where, right, this is a perfectly legitimate candidate that you should be giving a loan, a credit card, what have you too. But right, the traditional data just isn't going to show that. So they're always eager for things like these alternative data sources that show that they are great customers that we should be serving.
Okay, so let's now go to audience questions. If you have a question for Garrett or Ryan, now is the time to hit the Q&A button. Okay, we've got quite a few here. Intrigued to understand what it takes to create a frictionless journey for the borrower while ensuring the checks and balances. I know we've touched on that a little, but does someone want to give that a little bit more color?
I can start, and then Ryan, feel free to jump in. I mean, I think it goes back to some of the things before where, right, keeping the customer engaged is critical, right? You don't want them to have to log out and log back in. And I think the way we tend to do that is there are questions and things you're going to ask of a customer no matter what, just to service an application, and then tapping into alternative data sources that allow you to verify a lot of information about that person in real time without them knowing it, without them having to take additional steps. So, right, a great example would be as someone comes to your website, your application, right, you're profiling that device, right? You can see where that device is coming from if it's tied to that individual, right? To set up an account, we do a one-time passcode, right? We can verify that phone that they're applying from or that they're using to receive an OTP, right? We do email verification, all things that are just kind of necessary just to onboard a client, right? Those are opportunities to verify lots of information. The other piece, depending on the product, if it's a loan, right, you need to collect bank account information to know where to send that, right? You can quickly and easily verify bank account ownership on the back end, right? Similar story with address verification. So lots of things you can do with data that you're collecting regardless, just to run a credit decision or service a loan. And calling out to creative data sources to say, okay, yes, we have a really good sense of who this person is, what their credit worthiness is. And again, right, tools like the Work Number to even verify their income and employment. So doing as much as you can in real time in the background without requiring additional steps of the customer is critical. And then I think it kind of ties back to something I was touching on earlier is as soon as you start putting friction in front of the wrong people, you start to get the wrong outcomes, right? Adverse selection becomes a huge thing with poorly optimized funnels, right? Bad actors, more desperate people are generally going to be the ones that are the most willing to deal with a poor application experience. Your best qualified customers are the ones that are most likely to go somewhere else. So having that really clean, pristine experience for 90% of your customers is really critical. And then always having, right, those alternative fallbacks, right? There's always got to be an unhappy path or many unhappy paths, but being really targeted in who you apply those to is really what we spend a lot of our time thinking about.
Mm-hmm. Mm-hmm. Okay. Next question. What are some ways to get lenders more comfortable with using alternative data? Who wants to take that?
Yeah, I'll take a swing, and then Garrett can chime in. Again, I think a big one is simply our partnership relationship with companies like Amount. Amount's expertise is around decisioning, around all the things that Garrett described earlier in our introductions. The lenders are really already natively familiar with a decisioning tool or a loan origination tool such as Amount or various technology platforms. Something that our lenders really, really appreciate is not having to adopt the Work Number through a separate direct integration. The fact that we have a pre-existing integration around a whole set of solutions with a decisioning tool and a technology tool like Amount really, really eases the adoption and the speed into a production situation for a new lender. They're familiar with Amount. They trust the Amount team. They're getting to know the Work Number. They want to understand how to put it in production. The fact that the technological lift is minimal, if at all, due to the pre-existing relationship that a data provider has with their workflow tool or decisioning tool like Amount, that offers a lot of peace of mind and lessens the burden on introducing a new data set. And then I would also say the fact that not being the first lender to go into that sort of position. Other lenders, there are certainly lots of lenders that aren't afraid to be an early adopter or to be a pioneer and be the first to implement a new technology or a new data set or both. But many lenders love the peace of mind that other lenders have used this data set through this tool and have done so with success. That offers a lot of peace of mind for lender B and lender C to go down that same sort of path. So I really love the relationships that we have with companies like Amount. These partnerships really are a win-win-win. The Work Number data is better with partnerships like Amount. We we're not in the decisioning tool or the technology business per se. We are happy to offer direct integrations, but we're thrilled to deliver data through technologies like Amount, where that pre-existing integration is already built and already ready for hundreds of lenders to activate. So these relationships with Amount and all the technology companies in that space really help these lenders adopt these types of data sets a little more quickly and confidently.
Yeah, appreciate all that, Ryan. Yeah, right. We certainly like to think we make it easy, right? So if someone's on our platform and says we want to use the work number, it's zero tech effort on their end. It's flipping a switch. I think the other piece is, right, there's like the technology integration piece we think we handle, but if someone's just apprehensive about a new data source, right, conservative lending institution, right, we like to prove it, right? So we can pull something like the work number in the dark, not actually decision on it, and then say, hey, for these 100 applications that you asked for a bank statement, we got the exact same information. It just took 3 extra days, costed some extra money, and you lost 50 other customers that, right, you could have approved, right? So just being able to kind of just show them with real numbers and real data that like these tools work and are effective is a tactic we like to use. So, right, just running things, showing alternative data kind of just in the background and proving out the value empirically is something we love to do.
Okay, next question. This one is for you, Ryan. Does the presence of the work number in an application affect the probability of approval from a lender?
Yeah, so Garrett's actually touched on this a few times during the presentation. The lift lender to lender without and then with work number varies. Some programs do a really good job without a source of verified income and employment provider, some not so much. So on average, I think we see conversion rate lift in a mortgage program versus an auto program versus a card program will vary, but sort of broadly, holistically across different loan programs, we pretty confidently see application conversion rates lift by 30% or more. That's kind of a safe, and again, some less if you've already got a really efficient program in place and a slick UI. But we can see conversion rates, lift north of 40%. It really depends, but it's really, 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 really rare that we wouldn't see a lift that covers the investment of setting up this sort of waterfall.
Okay, one for you, Garrett. Is Amount an end-to-end lending automation platform?
Yeah, I think is the short answer. Right. So and end-to-end can mean different things, but basically we do everything from accepting an application, right? So someone clicks on a link that says, I want to apply for a loan, credit card, open a deposit account, right? We handle that full application experience. We run credit, pricing decisions, eligibility decisions. We verify identity. We verify income and employment where relevant. Right. If we're talking small business loans, we'll do KYB, we do KYC for consumer, OFAC, AML, BSA, all of the typical verifications, all the way through signing a contract and offboarding onto your core.
Okay. Okay, another one. This could be a whole nother webinar, but love to get your quick take on it. In which point of the loan cycle can you implement generative AI?
Yeah, it's I guess I can start there, right? It's what we have done thus far with generative AI has mostly been what I would categorize as enterprise search. So we have lots of documentation and internal SOPs and processes, and basically exposing that to a tool that allows us and our clients to search, right, that information, right? So say you have a question about how we do something on our platform, right? You can ask that question, it'll give you an answer, and it'll link you to relevant documentation. As of yet, we haven't exposed anything to be customer facing, probably for obvious reasons. There's a whole slew of, potential regulatory concerns, and right, LLMs still hallucinate, and there's a whole lot of things you need to be really confident about before you make that a customer-facing tool. Some of the other one of the other interesting use cases I'll just mention is around document processing. So again, we're trying to limit it as much as possible, but there are still cases where we get documents. There are ways where like a backend, someone working a document from a call center or working a queue can actually just ask a question of a document effectively. And we're working on implementing something like that. But for the most part, we're using it as kind of internal enhancements and exposing it to our like B2B clients, so the lenders we work with, but nothing directly customer facing.
Okay. Another one here that could be another webinar. How do we prevent first-party fraud for business borrowers?
Yeah. I'm happy to jump on that one, but I've been talking a lot lately, so Ryan, you can feel free to.
Yeah. So fraud, again, back to FCRA, fraud is not a permissible purpose. So the work number is not a fraud tool in and of itself. However, for identity validation, there is a value to the work number just in terms of the rigor that a payroll record has to go through when an employee gets onboarded. An employee goes through the I-9 onboarding process. A lot of background checks happen. And so even though the work number in and of itself is not a fraud tool and fraud is not a use case, we have heard from lenders that not only the delinquency sort of behavior or the performance of a loan that passes through the work number performs at a higher level than a loan that was made through another manual review. The performance of a loan, and we've also heard from fraud groups that they see a difference as well in the activity that occurs in their loan portfolio that passes via the work number versus some other manual review. There's definitely a difference. So that's about as far as I can take the fraud topic with the work number not being inherently a permissible purpose, but there is a behavioral difference in the loan performance that passes the work number versus some other type of review. And I'll just stop there and pass it back to Garrett.
Yeah, I mean, first-party fraud is a massive topic in its own right, and it means a lot of different things to a lot of different people, right? Like some lenders we've worked with consider it a credit problem, some consider it a fraud problem, some kind of somewhere in between, and it's right depending on how it manifests itself, right? It could be the case that someone is, just doesn't care. They're liquidating all their assets and moving to Costa Rica, and they're going to take out as much as they can. In which case, there's not much you can do to prevent that, especially if you're the first stop they make. Generally, I think what we've seen a lot of first-party fraud is someone that's just simply gotten in over their head. And I think what we found to be effective in that regard. So first of all, I've worked, in a prior role, right? I actually worked on first-party fraud models. And again, it's a little bit of a marriage between credit and fraud. And some of the most predictive attributes when you're building those models are actually coming from the bureaus. Just behavior you start to see either like increased utilization or right recent applications, kind of loan stacking behavior. But in terms of how you deal with it, generally the most effective thing that we've seen has been verifying that income and employment. Because sometimes what drives someone to commit first-party fraud, or whether, right, I think a lot of time first-party fraud gets called first-party fraud when it's really just ability to pay, right? Maybe this person wants to repay you, but they're just in a tough spot. And verifying income kind of viewing cash flow is really what we found to be the most effective way there. There's no silver bullet or magic solution for solving first-party fraud, but I think the same will be true. I think the question was maybe about for businesses. I think there's a similar story for small businesses. Is you can start to maybe see what their cash flows in and out look like, right? Are they have their inflows reduced lately, or are their expenses grown? Like, what does the utilization on their existing credit lines look like? Is this someone that's just kind of strapped for cash? So, no short answer to solve first-party fraud. I would love to say that I have that answer, but I think to Ryan's point, like we also absolutely see better credit quality for applications that verify income through a tool like the Work Number versus other more painful steps. So, while not a third-party fraud tool, there is some effect there.
Okay, next question. This is one for you, Garrett. So your waterfall has the Work Number first, and then a credentialed payroll or maybe a bank log. Have you seen differences in conversion success based on how you present the options after the Work Number, such as bank first and then credentialed payroll, or vice versa?
Yeah, I think, frankly, the simple answer is generally people know their bank login information better than they know their payroll log information. And that's probably one of the biggest factors, is just how easy is it for customers to do it. And I think the coverage for those providers so far is better, right? So I think we tend to lead with that first. And I think we've seen more success there. Obviously, these spaces are developing every day, but that's generally what we see.
Okay, so I want to close with a forward-looking question I want you both to answer. What's it going to take? Because when I look at this, I feel like it's a no-brainer. It feels like in 2024, doing a borrow application, unless it's like a small credit line, BNPL or something like that, but doing any kind of significant credit approval, you need to have income. You just need to have that data. It's easily available now, as we've discussed. So what's it going to take to get to, you think, 100% coverage of every single lender now just does this as a no-brainer? And how far away are we from that? So maybe Garrett, I'll start with you, and then Ryan, you can finish it off.
Yeah, I think so first of all, just about every lender we work with for any reasonably sized loan is verifying income in some capacity. And we always push our clients to use the Work Number and then kind of our standard waterfall. So I think we're absolutely moving in that direction. I haven't encountered too many cases where people are foregoing getting income. I've never seen a credit policy that doesn't factor in DTI. And it's easy to get the debt part of that calculation. The income is the
yeah. I guess what I really meant was people doing income in an automated way rather than having someone have to load up.
Yeah. So gotcha. I guess I probably have a biased view because we do as much as we possibly can in the automated sense. So almost everyone we work with is doing that. But I think maybe one of the reasons why we exist and why we're successful is traditional lenders maybe are not already doing that. So I don't know, Ryan might have a more interesting perspective on what they're seeing out in the market and what their adoption rate is. But I think part of the problem is just some lenders technology is hard for some banks, right? And that's why they come to providers like ourselves to make it easy and do those things for them. So I think that's probably the biggest obstacle is banks just getting their technology stacks and teams up to speed to do these things that feel like, I would agree, is a no-brainer.
Yeah. Ryan, you can bring us home.
Yeah, what I would say there is, the Work Number invests lots and lots of resources into expanding coverage. Just in the past 2 years, we've gone from 120 million active employment records to 145 million to 152 million. We're up to 170 million active employment records. So the Work Number is relentlessly trying to grow the database and does so and can demonstrate that we're doing that and not slowing down. However, I don't see us having 100% coverage anytime soon, nor anyone else anywhere in the market. There's never going to be a silver bullet that's giving a lender 100% coverage. So I think that's just something folks have to sort of accept and understand why that's the case, and then want to work with companies like EWS, like Amount, that are really sort of a bit agnostic and just really partner with each other. We love to partner with Amount. We partner with Amount's peers in the loan technology space. Amount really enjoys EWS and the Work Number, but they partner with lots and lots and lots of different data providers. So we're just humble enough to be consultative to our clients and offer flexibility and encourage choice, and then work with each lender to position the waterfalls to make sure that their loan performance operates as well as it can. And we're just trying to get as close to 100% coverage as we can, so that burden on the people and those other manual reviews just becomes less and less and more efficient.
Right. Well, it's a good place to leave it there. Well, Ryan, thank you so much. Garrett, thank you. And of course, thank you to Equifax Workplace Solutions for sponsoring this webinar. And of course, thank you to the viewers for your engagement and your questions. And I think that's it. Have a great afternoon, everybody. Thanks. See ya.
Thanks, Peter.